Good morning. My name is Matt Hafter, and I'm a partner here in the Chicago office of Thompson Coburn, LLP. It's my pleasure to welcome you to this webinar. My practice focuses on mergers and acquisitions, financing, and technology transactions such as licensing, technology development, and outsourcing. And in the outsourcing arena, I'd say about 65% of my work is for customers and the balance is for vendors. And for today's presentation, I'm going to be speaking generally from the customer's point of view just to set the stage for that. We'll get into the substance of the presentation in a minute, but first I have some housekeeping matters that we have to get out of the way. This program is CLE certified in California, Illinois, and Missouri. We will send you a CLE certificate once we verify your attendance. In order to register for the webinar, your login is proof of your attendance and supports granting the CLE credit. So if you do need to leave the webinar, you should log out and then log back in when you return. To verify your attendance, you're going to have to fill out a verification form that was included with the login instructions that were sent to you. And during this webinar, I'm going to mention 3 code words which will appear in the slides, and when these code words appear, you should write them down so you can provide them with the verification form. If you do have any CLE questions, please let us know at cle-tc@thompsoncoburn.com. I'd also like to invite you to send in any questions about this material. Whenever I can, I'll try to answer the question in real time, but I'll also leave some time at the end of the presentation for questions. The webinar is 1 hour long, and I'm more than happy to stay on the line for a few extra minutes to take questions, or we can certainly chat offline. We'll also be sending you an electronic survey form. We'd really appreciate it if you could take a few minutes and fill out the form and return it to us. All joking aside, we are planning to do a series of webinars on outsourcing, and any feedback you can provide us will be extremely helpful to us. All right, let's get down to business now. Here's an overview of what we're planning to cover in the next hour. My goal will be to give you a good framework for thinking about service level agreements and how vendors and customers can work in collaboration with one another to achieve a good result, and also to prompt you to think about these issues in relation to your own procurement or service delivery processes. If there are any Ohio State University graduates in the audience, you'll recognize this photo. As a Michigan guy, it kills me to showcase Ohio State's campus, but this is actually a great illustration for an overriding theme that we're going to cover today. No matter where the landscape architects map out the sidewalks, students will walk where they want to. The users of the space are going to determine how it should be designed, no matter what ideas somebody else has about where they should go and how they should get there. So in the landscape architecture world, probably it's best to let pathways emerge and then pave over them with a sidewalk. And the same is true for SLAs, service level agreements. We can add language, for example, that software must be error-free, or that services will be delivered in a workmanlike manner. But how does this really translate to the actual operation of the project covered by the contract? And that's what we're going to focus on today. And here we come to our first secret word, hurdle. Please make a note of this so you can record it in your attendance verification form. To get this right, to get the service level area right, requires a lot of upfront work. And unfortunately, often we're so happy, as a customer at least, to get the RFP out the door. Everybody just wants to bail out after that, but that's a bad idea. These relationships are typically long-term. They involve important technologies or business processes for the customer and a large dollar spend for the customer. So getting it right really requires a sustained effort. First, it's important to make sure that all the constituencies start off and end up on the same page when it comes to the business and technical objectives. There are always some tensions between the customer's business unit, who's actually going to be the user of the services or the deliverables, and the procurement function, for example. The business unit wants the best service package, and procurement may be focused on getting the lowest price possible. So it's important to have everybody in sync on that. It's also important to have good diligence on the vendor. Make sure that the vendor has the technical expertise to deliver the services and the financial stability to provide staying power that they can last throughout the term of the contract. You also may want to know, for example, you may want to perform a risk assessment to assess, for example, geopolitical risk. I actually am working with a client right now that is getting software application development services from a company in the West Bank and the Palestinian territories. Needless to say, that's a volatile area of the world. As part of this client's diligence, they actually traveled to Israel to ask Israeli business leaders what they thought of the idea and how they assessed the stability of the situation there. After receiving an enthusiastic endorsement of the idea from people who actually could be considered political adversaries, my client went ahead with the deal and has been very pleased. But you certainly want to make sure that you understand the geopolitical landscape and wherever you'll be, whether that's China, whether that's the Philippines, whether that's Vietnam or any other area. And then on both sides of the equation, both the customer and the vendor should game out what things will look like if the relationship fails and there's a need for a business divorce or a conscious uncoupling if you're from Hollywood. Both sides need to think about how to separate without unnecessary damage or impact. So this might involve how transition services are provided, how data stored with the vendor is managed, how personnel are downsized with the vendor, things of that nature. And this is really where SLAs generally come into play. SLAs should be used to motivate both sides to achieve their overall business objectives in the deal. On the one hand, delivery of quality service for a good value, which is what the customer wants, and from the vendor side, they want a stable long-term revenue stream. The terminology varies among different deals, and when there are acronyms coming out the door for all of these various descriptions of how the service levels work. But in essence, we're really talking about three basic ideas that provide the framework for the service level discussion. First, the customer has to identify what its key performance indicators are, or KPIs. These KPIs are what the customer considers the important elements of the service that the vendor needs to provide that are really vital for the customer to get the benefit of its bargain. Without delivery of these KPIs, the function that the vendor is performing isn't really worth paying for. And these KPIs vary depending on the type of services or other deliverables that are being acquired. For example, a SaaS deal usually has a service availability or uptime requirement as a prominent performance indicator. Help desk deal would have response time and resolution time as an important KPI, or an application development deal would have software bugs as the KPI. We'll talk more about that in a second. Second, and in the next iteration down, once the KPIs are established, the customer has to decide what are the minimum acceptable quality levels, below which there's really no point in doing the deal. If the customer doesn't get those minimal acceptable quality levels in those key performance indicators, then they're not getting anything of what they're paying for. They might as well keep the service in-house. And related to that, the customer needs to decide what is the degree of tolerable variance from the quality levels and the KPIs that are acceptable, even if not ideal. So the customer has to figure out what is the desired or optimal service levels for the various services and KPIs that the customer wants to receive. And then once those decisions are made, then the service level agreement emerges from that. Service level agreement, or SLA, states the necessary quality levels, the degree of variances that are acceptable. It then will go into how the vendor's performance will be measured against those quality standards and the consequences for failing to meet those standards. And there are three basic buckets to be thinking about as the parties go through this analysis. First, on the left-hand side of the slide, the what. What performance metrics are you measuring? Note here that it's really very helpful to be clear about what the parties' assumptions are as they formulate these standards. For example, if a software deliverable requires a certain hardware configuration to operate, then that assumption needs to be stated so that the customer can know that it has to come to the table with that hardware or find a way to get that hardware. And if there's a glitch down the road, it really needs to focus on the software, and the customer needs to provide the operating environment for that to happen. So that's an example of a key assumption that needs to be articulated openly. Next, in the middle column, how will the vendor's performance be measured? There are all kinds of ways this happens depending on the specific services or deliverables, and we'll get to that in a second as well. And it's also important that third bullet point under the how column is really, really important because often what happens is that different constituencies, different business elements within the customer are writing these things up. And often you'll end up with something that resembles a Frankenstein kind of approach where the parties even within the customer are using different defined terms, different concepts, slightly different focus to what's happening. And so everything here needs to be synced up so that it works together smoothly, that the cross-references amongst definitions are clear, that the concepts are consistent throughout the master services agreement, the statement of work, and the service level agreement. And then finally on the right-hand side, the why of it all. Parties need to decide what they hope that the SLAs will accomplish for them. They need to decide what the financial consequences are for either below standard performance or outstanding performance. It's also important to consider that many master services agreements have a continuous improvement concept in it, which from a customer perspective is code for making the vendor do it faster, cheaper, and better. And the SLAs are really important as a way of measuring this evolution. The SLAs also need to be linked to the overall governance and management of the relationship. For example, if a vendor trips an SLA wire, that may be a good reason for senior management of both parties to meet, get together, and discuss what it is that's going on before the problem persists and before SLA service credits pile up and before people get themselves in a more serious problem. So these can be tripwires to help people avoid those kinds of problems. There are a variety of hard data and soft data points that can go into SLAs depending on the nature of the services. And often it's actually a combination of objective performance measurements and subjective customer satisfaction reports. I've listed some examples here. These actually, in the example section of this slide, were all in a single business process outsourcing deal I did. And each is directed to measuring a different important facet of performance that was critical for my particular client in this deal. So we measured uptime and availability of the service. Another element measured the vendor's response and solution time. Yet another metric measured user satisfaction. And that can be something as simple as either the customer's user satisfaction or the customer's user satisfaction. So in a particular case I'm thinking of, my client was a financial services enterprise, and we wanted to measure the satisfaction of my client's own customers as they interacted with the services that were being provided. And often you'll hear, if you call in for support, for example, on an 800 line, you'll be asked if you want to take a short survey afterwards, and very likely that that's part of what's going on with that survey. And the parties have to then figure out what tools they're going to use to measure performance. And some of it will depend on what it is that's being measured. So for example, customer satisfaction is often measured by surveys. Other elements of performance are measured by timing, so uptime over the course of a particular month. Other elements are measured by software bugs and the prevalence of software bugs in a particular deliverable. So the parties really have to figure out what it is that they're measuring, what the content of the reporting from the vendor to the customer will be, what data needs to be collected, what format, and whether there should be, for example, a root cause analysis that the vendor provides to explain why it is that performance fell short. And then the parties have to give some thought to the timing of these reports, and usually the measurement cycle needs to coordinate with the billing cycle if there's going to be a linkage between performance and pricing. And then finally, the parties need to figure out what tools they're going to be using, and these ought to be agreed upon so that there's an objective standard to the measurement process, and that it's transparent and hopefully automated so that not a lot of human interaction needs to go into making it all work. And hidden within this slide is also another important point that that defects in reporting or reporting accuracy in and of itself can be a key performance indicator, and failure to have accurate measurement and reporting can be an SLA failure in and of itself. So in this slide, we have a few examples of how to describe performance and the severity of what's going on if there's a service level slip. In some cases, it's described as significantly below, at, above, or significantly above the required service level. Sometimes it's described as percentage of time that the service is unavailable. Other times it will be the time to deliver a deliverable, respond to a problem, or resolve a problem. The next item relates to some of these subjective factors of customer satisfaction. And in the bottom, we have often a linkage between the severity of the issue, the performance issue, and the impact on the business. So often SLA performance will be tied to a series of tiers or severity levels. So for example, the most serious can be an incident that has an extremely serious impact on the business. And that the impact of the problem is felt across the enterprise or by a large number of people, or that a very important business function is stopped. That would be severity level number 1. Next down from that will be an incident that has a significant impact on the business, but the business function involved is not stopped. The next level down can be an incident which affects the service but has a small impact on business, and the vendor can provide a workaround. And then finally, there might be incidents that have a negligible impact on business and that are really more in the category of inquiries or requests for information or requests for non-urgent support. So you can see how with this stratification of impact on the business, that can be tied to the actual thing that's being measured. So let's take percentage of time unavailable or uptime. If the service is a SaaS service, for example, and it relates to a particularly important function like billing, for example, for the customer. Billing is obviously key to the customer's cash flow and revenue. That would be, problems there would have a more heightened security level, because failure for the service to be available can have a very significant material impact on the customer, whereas minor glitches or formatting issues in the nature of a bill or a report. It doesn't affect cash flow and revenue for the customer. It's a nuisance. It's something that needs to get addressed, but it doesn't cause the whole operation to shut down. And here is our second secret word of the day, javelin. So make sure you make a note of this so you can record it in your attendance form, javelin. Most agreements for outsourced services and deliverables have a range of remedies. Most of these deals contemplate performance over a long period of time. The parties usually devote a huge amount of human and technical resources to perform. They build up a large infrastructure to make this deal work, and so there really need to be a variety of solutions for problems other than simply tanking the deal and walking away from all that invested time and capital. Tanking the deal is always an option, but it shouldn't be the only option. So, for example, the customer and the vendor are going to want to preserve a right for the customer to receive a service or a fee credit. That's what we would consider under an SLA credit. So the customer would keep the deliverable or keep the service and just lop off some money from the invoice to reflect the lower value of the service given whatever the problem was. Another way of dealing with it can be under warranty service. So for warranty service, the vendor would be required typically to either re-perform the service to fix the deliverable, or would allow the customer to find an alternative supplier. This is similar to the customer obtaining cover as in the sale of goods concept, so that the customer is made whole either through re-performance by that vendor or getting it from some other vendor. And usually the cost of those items is either of re-performance certainly is borne by the vendor, and the cost of obtaining alternative supply is borne by the vendor as well. There are other special remedies depending on what the issue is. For example, intellectual property problems are often solved by the vendor obtaining an additional license if that's needed to resolve an infringement claim. The customer sometimes may have step-in rights to completely take over an element of the service that the vendor is performing. Or the vendor may be required, for example, to work with government agencies or the ultimate end users of the service to fix a problem. This is often the case where there's a data breach, and the vendor has to cooperate with investigating agencies. The vendor might have to provide credit reporting services to the customer at the end of the day. Finally, there are damages that the customer may want to assert against the vendor for breach of contract, and then the nuclear option, termination for cause. This might arise if there is a single breach of some very material element of the contract, or it might arise if there's an accumulation of relatively minor breaches of the contract. For example, if there's an accumulation of a certain dollar amount of service credits such that the customer at that point really isn't getting the benefit of the bargain, and the vendor is kind of slapping its way through performance. Now, from the vendor's perspective, they're going to be very concerned about revenue recognition. These remedies, particularly remedies that require performance and re-performance over a period of time, like warranty service, that's going to be an issue that a customer will hear about. And it occasionally is overused by vendors, but it's a very legitimate concern. They really need to be able to recognize revenue within some definite time and not too long from the time that the service or deliverable is actually provided. Otherwise, their financial situation is going to be in flux. Their lenders are going to be very concerned about that. Their investors are going to be very concerned about that. And the one thing you do not want is a financially unstable vendor if you have a long-term relationship with them. Some detail on that: if there's a very long warranty period, a year, for example, the accountants may not allow the vendor to recognize the revenue for that particular deliverable until the warranty period is expired. So waiting a year to be able to take that payment into revenue or to release a reserve for warranty services simply may cause too much of a problem for the vendor. So it's this is often the case of sort of a mix and match situation. In exchange for a shorter warranty period, the customer may be able to negotiate more stringent service credits or fee credits. The service credit alternatives will depend on what's being measured and how critical it is to the customer's overall performance and the vendor's overall performance. Typically, the parties will agree up front to an at-risk pool of fees. Typically, this is somewhere in the range of 15 to 20 to 25% of, for example, the fees payable monthly. The vendor isn't going to want to have all of its fees in jeopardy for a particular service level issue because the vendor has fixed fees that it has to pay. It has to pay for infrastructure, has to pay for personnel who are providing these services. So the parties will agree on an at-risk pool, and then the service level will be taken out of that. Sometimes it's simply a flat fee of a particular dollar amount per service level issue. Sometimes it's a percentage of the fee. Sometimes it's an escalating amount. So the first service level breach is 12% of the fee. The second time it happens in a consecutive months, it's 25%. The third time it happens, it might be 50%. And if it happens a fourth consecutive month, then the customer will have the option of either terminating the contract for cause, because at that point something very wrong is going on with the vendor, or if the customer wants to, they can stay with the contract and simply continue to receive a 50% credit on their account. Also, as I suggested before, there might be a weighting amongst the different services depending on which are most critical. Uptime in a SaaS situation may be the most important single element, and so that will have a higher weighting given its critical importance, as opposed to, for example, help desk functions from the SaaS vendor, which may have a less of a degree of importance and sort of mission critical element to the arrangement. And it's also the case that vendors will ask for, and certainly in the first instance deserve, a honeymoon period. There's often a ramp-up transition period as the vendor gets its own systems online, gets the hang of working with these services and deliverables, and the whole arrangement is working out its kinks. That honeymoon period is fair to ask for in most cases, and it's appropriate to provide and give the vendor. On the other side, vendors often will ask for an earn back or a bonus for excellent performance. And customers often say, I'm paying for excellent performance, and so you don't deserve a bonus for that. And when hearing that, the vendor will usually need to go back, sharpen its pencil, and reprice the deal so it builds in the bonus without it being called a bonus. At the end of the day, the agreement will have several ways to address performance failures, and they nest together like a set of Russian dolls. At the core of it, there will be violations of key performance indicators. Often this will require a root cause analysis by the vendor. The customer may insist on warranty. There's also an element where the degree of performance will not be so bad that it would require a termination for cause, but the customer simply is not getting quite the value it wanted to out of the deal, or it's just taking too much time and effort for the customer to manage the process. And in that situation, most of these contracts will have a termination for convenience. Termination for convenience is a good exit strategy for the customer, but in those cases, oftentimes the customer will either have to give a long period of advance notice, or the customer may have to reimburse the vendor for the vendor's sunk costs and costs to transition its employees onto other projects. I'd like to now go into one case study. I don't want to make this into a law school lecture, but there's one very interesting case that kind of wraps all of these issues into one. It's a case that happened a number of years ago between the state of Indiana and IBM. In this case, Indiana retained IBM to modernize and improve the state's welfare eligibility system, basically set up web-based access to these services, a call center, and so forth. And this contract would be performed over 10 years and involved a spend by the state of about $1.3 billion. As performance went on, problems emerged, including slow processing of welfare applications, higher costs because of errors in eligibility determination. In other words, the state was having to pay more benefits to welfare recipients than it otherwise might have. And also two other events occurred. One was the 2008-2009 recession, and the second was a series of natural disasters within the state that greatly increased the demand for welfare benefits beyond what either party could have originally anticipated. Indiana had put out, the state had put out some laudatory press releases. The governor in his State of the State message was congratulating himself on what a great job had been going on with this contract. But eventually, Indiana terminated the agreement for cause. And the question for the court here was whether IBM's breaches were material, considering the agreement as a whole. And finally, it went up the state court system, and the Indiana Supreme Court held that, taken as a whole, these breaches by IBM were material. And one of the key elements of evidence that the court looked to was a purpose statement at the beginning of the agreement between IBM and Indiana that articulated the basic standard by which Indiana articulated whether it was going to be getting the benefit of the bargain. It articulated a handful of points that in the state business objectives that the state wanted to achieve. And the agreement between IBM and Indiana provided that a series of even non-material breaches could collectively constitute a material breach when considering the agreement as a whole, on the rationale that with those accumulated non-material breaches, at some point the state really isn't getting the benefit of what it's paying for, and it's not accomplishing these overall objectives that were articulated in the purpose statement. Performance in this contract was measured by 8 specific service level metrics, 4 categories of performance indicators with financial consequences. The court described these financial consequences as liquidated damages. We'll cover that point in a minute because it's very significant. And it's also noteworthy, to me at least, that some of these key performance indicators were subjective measurements from the end user. And as long as it was not determined arbitrarily, these subjective measurements were honored by the court as valid performance measures. The court ultimately held that payment of the liquidated damages, the service level credits, did not excuse IBM's material breach. And the court also held that the breach was material even though Indiana did receive some of the benefit of its bargain. It was not an abject failure. To me, there are a few takeaways from this contract. The first is the importance of having a very clear purpose statement of the business objectives that the customer is trying to achieve with the contract, with the relationship. This is important both from the customer perspective, of course, and from the vendor perspective. It's very important, I think, for vendors to understand what it is they're getting themselves into, what it is that their customer expects, and what kinds of resources the vendor will need to satisfy those requirements. I think the second takeaway here is that it's very helpful for the customer to speak with one voice. The court noted the sometimes contradictory positions taken by representatives of the state of Indiana in, for example, the government's State of the State speech and in other performance assessments. It didn't stop Indiana from winning the case, but it made it a lot harder. And then the third element is the importance of a broad range of performance indicators to really take into consideration and to capture the full range of services that are valuable to the customer. If it's valuable to the customer, if it's important to the customer's business, then it should be measured and assessed. The third word for attendance purposes is hammer. We're working on a track and field theme here, hammer. So I mentioned a second ago that the issue of liquidated damages and the range of remedies that the customer has is important. And it's critical for the agreement between the vendor and the customer to have language really spelling out what it is that's happening in terms of remedies. So this is a sample of language that makes it very clear that the service credits are a price adjustment to reflect the reduced level and value of the services, and that they're really not an estimate of the loss or damages. And that the issuance of service level credits is not an exclusive remedy. It doesn't limit the customer's right to other remedies, including damages, including injunction, or including the customer's ability or right to terminate the agreement for cause and to recover damages for breach of contract. The issue of liquidated damages that the court articulated really needs to be done very carefully. There is a general consensus among all of the states that liquidated damages are enforceable, but use of words like penalty or to concepts of forcing the vendor to perform make the liquidated damages provision unenforceable. So some real care needs to be given to drafting the provision here. So in order to have an enforceable liquidated damages clause in general, this is all dependent on state law and state case law, which varies across the states, but the general theme is that the liquidated damages have to bear a reasonable relationship to the anticipated or actual damages. They can't be excessively harsh, or they will be deemed as a penalty rather than compensatory, and that's really the key axis on which enforceability is judged. The amount of liquidated damages has to be reasonable in light of the anticipated harm caused by the breach, the difficulties of proving the amount of loss, and the inconvenience of obtaining some other kind of remedy. What you don't want to have, as from a customer's perspective, is such a large amount of liquidated damages that the vendor then builds that risk into the price. If they're concerned that they are going to end up having to pay a large amount of liquidated damages, they will simply increase their price for the services to reflect that risk. And then once the customer and vendor get to court, if it's too high an amount of liquidated damages, the customer essentially loses twice. First, they will have paid inappropriately high fees for the value of the services that they're getting, and they will lose on the enforceability of the liquidated damages provision. That's clearly not a happy outcome. If the liquidated damages are in the contract, that for that particular breach, that is all that the customer can obtain. The customer cannot sort of have its cake and eat it too. The liquidated damages is going to be the exclusive remedy for that particular breach. The court in the Indiana versus IBM case made it clear that payment of the liquidated damages did not, payment of liquidated damages in the form of the service level credits did not excuse other elements of breach and damage. And this is because the amount of the service level credits was deducted from the ultimate damages award. So customers have to be very careful about how they engineer those provisions. And as a final substantive wrap-up here, I want to emphasize that the service level agreement, the service levels, the key performance indicators, all of these things really shouldn't be viewed by the customer as an opportunity to punish the vendor. Rather, in my view, they should be seen by both parties as a way to really clarify the operation, the mechanics, the actual delivery of real services in the real world and in real time. Remembering the very initial slide I showed of the Ohio State campus where the pathways were defined by the actual users of the space. This is an opportunity for both parties to get together and make sure that both of them get what they want out of the deal. Vendors are entitled to a fair profit, and they are entitled to know and to understand what it is that they're supposed to be doing. And the customer has obligations too. The customer has to provide feedback. The customer may have its own contractual obligations to provide various infrastructure, to obtain various licenses. The customer ought to be willing to and have a process to resolve performance issues when they are escalated beyond above an operational level to an executive level. The customer should be willing to have a discussion with the vendor about adding, deleting, or modifying the service levels so that they are appropriate to motivate excellent performance, but they're not unachievable, and that they also reflect what we all would hope to be greater efficiencies as the vendor gains more experience with these various processes. And finally, customers are obligated to, if they want to get what they want, they're obligated to say what they want, to give reasonable instructions from a well-organized internal structure where the vendor is receiving clear instructions with one voice, and they're not getting contradictory messages from the business unit and the legal function and the procurement function. So that concludes the bulk of my presentation. I recently put out a tongue-in-cheek and sarcastic piece on our blog about how to guarantee bad performance from vendors. It might be worth a quick read for hopefully a laugh. As I mentioned, we want to turn this into a series, and we are looking at our next topic as data security continues to be a hot topic in this area, and so we'd like to cover that with a broader range of personnel from our firm who have outstanding expertise in this field. Details on that to come. And I'm just going to mention once again our 3 secret words. Secret word number 1 is hurdle. Word number 2 is javelin. And word number 3 is hammer. or anyone who wishes is more than welcome to reach out to me by email or by phone to chat about anything else. I'd like to thank everybody for attending this program, and we look forward to seeing you at the next one, when we will announce that soon. Thank you very much, and have a great afternoon.